Opendoor Technologies, the stock that was inches from delisting at 51 cents, is now trading around $7. That's a 339% gain this year. But here's the question that everyone's afraid to ask. Is this a comeback or just another meme-fueled mirage? Because Opendoor isn't some SaaS company with infinite margins. It's a real estate business. And that means capital, debt, and razor thin spreads. Now, they buy homes, they renovate them, and they flip them, all powered by one thing: their pricing algorithm. And if that algorithm gets it wrong, they're holding millions in bad inventory. Now, here's what's wild. Opendoor wants to expand from 50 markets to the entire United States. If that rollout works, it could disrupt how Americans sell their homes forever. But if it doesn't, Opendoor could burn through cash faster they can ever sell their houses. And with a debt to equity ratio of 3.38, this company's leverage makes Tesla's early days look conservative. Now, most traders see a 300% run and think they missed the boat. But the signal that I'm watching says the story is just getting started, and it's hidden in their AI-driven pricing model. In this video, I'm going to show you exactly what that means and the one small tweak in that algorithm that could make or break the entire company. Hey, what's up? My name is Rick Orford. I've been trading since 1999, and no, I'm not a financial advisor. That's a good thing. I don't do hype. I break down the numbers so retail investors like you and me can make smarter, more confident decisions with our money. With all that out of the way, let's get into it. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. And you all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by almost 6 times. Go to fool.com/Ricko to get your 10 stock picks right now. Opendoor Technologies is a real estate tech company that operates as an iBuyer in over 50 markets in the United States. Now, iBuyers streamline the home selling process by directly buying properties from homeowners who post on their platform after a couple of assessments. They then perform any necessary repairs and then resells the properties on their website. On that same website, interested buyers can peruse the houses on sale by supplying a zip code. In Opendoor's own words, using their services means that you get to avoid the typical endless parade of home viewers when you're selling, manage your entire sale online, request competitive cash offers, skip the staging and showing process, choose your closing date, and much more. The company also offers services like real estate brokerage, title, and escrow processing, and as well as property insurance. Opendoor gets most of its revenue from service fees, which are typically 5% of the selling price, and let's not forget the margins on home resales. It also earns through additional offerings, though at a smaller scale. Now, recently, the company announced plans to expand its offerings from their current 50 markets to the entire United States. And for anyone that's worked in the real estate industry, you'll know that that's pretty huge news. Because if the rollout goes smoothly, Opendoor has the potential to disrupt the industry on a national level. Imagine homeowners skipping the stress and headache of staging, hosting, and multiple negotiations. Instead, they just post their property and wait while the company's streamlined service takes care of everything for them. So you could say that this expansion could either be the spark that turns Opendoor into a household name or the move that stretches it too thin. And stick with me, because what happens next could completely redefine how Americans sell their homes. Now, let's talk about the stock price, because that's why you're here, right? Now, the first time I covered Opendoor back in August, the stock was trading at around $2, and now it's closed around $7. As one might expect, that kind of increase does wonders for its performance. Opendoor stock has grown 339% year to date and 306% in the last year. Over the last 52 weeks, the stock has traded in a range between 51 cents and $10.87. It's quite a range. And to think that Opendoor was just an inch away from delisting just a few months ago, well, that's not just a comeback. That is a full-blown resurrection. But of course, that kind of move comes with increased volatility. The stock has a 3.69 60-month beta, and that means the stock is likely to move nearly 4 times as much as the S&P 500. For traders, that can mean outsized potential gains against outsized risks. So with Opendoor, you have some big upside potential and big gut checks if you're holding through the drops. I've learned that when a stock moves this much, the real question isn't just how high can it go, it's how long can it hold. Well, to answer that, let's dig into what's driving this rally. Now, I covered Opendoor's growth catalysts in my last video, which you can watch right up here. But as a refresher, here's a quick rundown of the positives. Opendoor's proprietary algorithm is direct beneficiary of the massive AI improvements we're seeing across the industry. As its system becomes more efficient, the company will likely see improvements in pricing models, automated decision-making for improvements and renovations, as well as overall transaction speed. So a sweeping enhancement on this front will likely lead to improved margins and better customer experiences. And here's the kicker. That same AI could help Opendoor avoid one of its biggest risks, mispricing homes. If it nails accuracy, it prints profits. If not, it bleeds cash. Now, speaking of customers, Opendoor's all online process makes it an attractive alternative to the traditional home selling experience. That means no open house, no haggling with buyers, and no endless back and forth with real estate agents. As someone who appreciates all the convenience of online transactions, I can see the appeal. So Opendoor, they're not just selling homes, they're selling time, simplicity, and certainty. Last, the company's expansion could be the real game changer that it needs. A wider geographical reach across different markets can translate into better scaling and increased transactions. If it works, this expansion could compound every other advantage. More markets, more data, smarter pricing equals higher margins. But every opportunity comes with risks, and that's where we head next. And it was recently brought up in my Discord, so let's get into that. So the first and biggest risk, the reality is traditional, established real estate brokers, they're not going anywhere anytime soon. Yes, Opendoor's process is more convenient, but tradition is a hard wall to break. iBuyers and brokers are competing for the same customers, and many owners may prefer the personalized touch and localized expertise of their existing agents. So Opendoor's competition isn't just other iBuyers, it's habit, and habit is tough to disrupt. Then there's the fact that the iBuying business model comes with razor thin, even negative margins. There's a reason why Redfin and Zillow bowed out of the iBuyer market. Buying, holding, and selling homes requires a significant amount of capital. And that's not even considering the cost of renovations, property management, taxes, and other real estate expenses. Success will depend on how fast a company can move properties and how accurately it can price homes to avoid losses. It's a high volume, low margin hustle. They need to flip houses fast or the debt is going to start eating into profits. And since it's operating on a single algorithm, any issue with the pricing model, no matter how small, can have a massive impact on their margins. And lastly, Opendoor, they still can't shake off their meme stock label, right? Aside from speculation, many traders haven't seen any justification for its skyrocketing stock price. Revenue is shrinking. The bottom line is still in the red. And if we take a look at its balance sheet, the company's debt to equity ratio is 3.38. It means they're relying heavily on borrowed capital to fund their operations. Now, look, speculation is fine, and I can name a bunch of companies that are trading way above their supposed valuations right now. But when all you have going for your stock is speculation, you may want to rethink that investing approach. I've learned that when a stock story sounds too good to be true, it often is, unless the fundamentals catch up fast. Now, I'm going to be covering Opendoor again in the future, including diving into its third quarter financials when they get released. So be sure to look out for it. So, the big question right now is Open Door stock a buy? Well, to answer that, we need to look at what Wall Street thinks. A consensus among 12 analysts rate the stock a hold. And if you look at the ratings distribution here, the scores, well, they're leaning towards more of a sell and hold than a buy. Translation: Wall Street is cautious and is advising investors to temper their expectations. And that makes sense. After a 300% run, even the bulls are nervous. But you can't fight gravity forever. And that makes sense. After a 300% bull run, even the bulls are nervous. And you can't fight gravity forever. But what do you think? Does Opendoor have a shot at improving its overall business? Or are they likely to shut down like Zillow and Redfin's iBuyer business? Let me know in the comments below. And while you're there, don't forget to like and subscribe because it helps others find the video, it supports the channel, and you won't miss out on any of my future deep dives. Well, folks, that's it for me today in this video. I wanted to thank you so much for watching, and I'll see you next time.